Hey there, everyone. Thank you so much for joining us for the expansion planning webinar that we're doing today. Please, using the chat box, let me know if you can see the PowerPoint slides that I am presenting. Let me know that you can hear me. And then also let me know if you got the workbook that we put together. I did attach that in the chat, the Word doc or the PDF document. So make sure you have access to that because we are going to be looking at that. If you are having any issues, you don't see the PDF document for the workbook in the chats, please let me know. And I'll see if I can get a link put in there when we get to the end. All right. So like I said, make sure that everything is working like it's supposed to. Okay, so you're not seeing the workbook. Okay, so let me try to upload one more time and make sure that it's coming up. Okay, so how about now? Are we seeing the workbook? Okay, perfect. It may have been just if you came in later than I had uploaded it, you may not have gotten it. So I might have to re-upload again at the end for people who may show up a little bit late. So that's a good thing to keep in mind. So my name is Rochelle Kalina, and I am the advisory director at Honest Buck Accounting. My role is to take the financial information that our amazing group of accountants put together for our clients and use it to help our clients plan and reach their goals. One of the biggest client goals is, of course, to own multiple centers. So the advisory team does a lot of work around ensuring that that our clients' current centers are financially stable enough to withstand the cash drain that tends to accompany opening or expanding a center, that their financials are lender ready and forecasting to show potential profit outcomes of expanding in order to kind of make the lenders feel a little bit better about what they might be funding. Okay. So let's move over. So welcome to part one of our two-part webinar series. So we're going to be looking at expansion and succession planning. Today we're going to be talking about expansion planning for your early education institutions, and during the second part of the series, which we're going to host in December, we'll be discussing succession planning. Okay, so let's see here. We're going to be looking at factors that we need to consider. We're going to be looking at a case study to show kind of to walk through what you need to be considering in all of this. You need to, we're going to be looking at whether to buy a building or purchase a building, or sorry, purchase a building or lease a building. We're going to be looking at inflation. And then we're also going to go through the expansion checklist. And I'm getting a message saying that some people still aren't able to see the workbook. So let me really quickly try to troubleshoot that. 1 second. Okay, I'm gonna go here, go into that. Let's see, go to my knowledge base, marketing. Okay, and so what I'm gonna do is I'm going to put in a link as well for anybody who, and let's make sure that everyone has access to that workbook. Okay. Let's see here. Okay. And oops, sorry. Now that I've had to rearrange my computer, nothing is exactly where I want it to be. Okay. So we're doing this on Zoom. And like I said, the best way to communicate is going to be through chat. Let me know if there's something that you are not seeing, something that you don't have access to. If you have questions throughout, definitely feel free to use that chat box to let me know that you have questions, and I'm happy to either answer them at the time or once we get to the end. Okay. So today we're going to talk about things to look for when you're thinking about expansion. Obviously, with the amount of cash that's being filtered into childcare, coupled with the increase in childcare centers for sale, relatively low commercial real estate prices, and lowish, getting higher, but low-ish SBA interest rates, it's really no surprise that many center owners are looking to expand. But as you know, not all childcare centers are equal. And we're going to take a look at some of the factors that you need to consider. So when you're deciding whether to open a new center in an area, the first thing you want to look at is the age of the population. Your target customers include parents and their children. So knowing an age breakdown of a certain area can help you determine if there's a demand for childcare business in your area. If you discover a high percentage of children, then there's likely a demand for a childcare facility. Where I live in Bella Vista, the median age of a resident here is 50. So that's not really a great area to start a childcare center. My sister, on the other hand, she lives in a younger, more family-oriented community called Cave Springs, where the median age is about 33 years old. This would be a much better place for us to take a look at if we were looking to open a childcare center. The next thing that we want to look at is the average household size. Families are the foundation of a childcare business, and to identify potential customers, you may want to look at families where the average household size is at least 3. And so you can see here that Bella Vista, the average household size is 2.43, whereas Cave Springs is at 3.09, which is a lot better when we're looking at a place to open up a childcare business. And of course, you'll want to look at median household income. Childcare is a considerable expense for families, so you'll want to find customers that can afford your services. And so you'll use a median household income to determine if the annual income of a certain area is high enough to afford the services. So again, if we're looking at the scenarios we're looking at now, Bella Vista has an average household income of about $71,000, whereas Cave Springs is about $134,000. So obviously a much more financially prosperous area. So from the research that we're doing so far, it seems like Cave Springs is an obvious winner, but we'll need to dig a little bit deeper. And that is that we'll want to look at the number of children that actually live in this area. And the tool that I use to find this information, and where I found a lot of this information already, is going to be the US Census Bureau page. And I believe there's a link to this page in that workbook that I put in the chat. And it will show you the population, it'll show you average household income based on the latest census data, but it'll also show us here persons under 5 years old. And so what we can see with this information is that in Cave Springs, because it is a small little suburb, the population is 5,900 people, and the population of children under the age of 5 is about 600. So that's not a lot of children. So the next question is, where is the closest childcare center to Cave Springs? And what we're going to find, I'm going to actually move past that, is that there are several centers that are within a 5 to 10 minute drive. So obviously proximity to other centers is very important. If there's already several centers close by, you'll probably have a hard time filling up the center. But when I'm looking at whether Cave Springs is a good location, I'm going to use Google Maps like I am here to look and see what the competition looks like. But another resource that I can use is this website called childcaredeserts.org. And what we can see here in this area specifically is that while Cave Springs right here seems to be a childcare desert, because it is marked as orange, there is a decent amount of supply nearby within a 5 to 15 minute drive within Bentonville, Lowell, and Springdale. They all seem to have plenty of centers there. So given the small supply of children and the adequate number of childcare centers in the area, Cave Springs may not make the most sense as a place to open up a childcare center. However, let's say we found a great space during our search process, or we decide to open up an in-home center in this area. Again, Cave Springs is a young family-centric area with parents who earn a good living. How can we do some quick math to make sure that the numbers will make sense? Generally speaking, with a large center, meaning 80 plus students, you'll want your rent expense to fall between 10 to 15% of your total revenue in order to break even financially. With a smaller center, the less fixed rent you want associated with your center. So if you have 50 or fewer students, you really want to keep your rent expense at 10% or less of your total revenue. So this would definitely count if you were looking at like an in-home center or something like that, where you had employees. With this in mind, you can divide the rent or mortgage amount by the percentage of rent needed in order to figure out kind of an approximate break even. So this figure would tell you the minimum income you would need to bill in order to make the center work financially. So let's say you found a space for $2,800 per month. If your rent should be about 10% of your revenue, you would divide 2,800 by 10% to get to a total of 28,000 per month in monthly revenue needed. Now let's say that you charge an average of 1,200 per month. That means that you would need to enroll 23 full-time students in your program in order to break even. Keep in mind that this is just an approximation to help you quickly determine what's feasible. If you decide to get serious about an actual location, do a comprehensive multi-year forecast with your accountant. This is just kind of a quick back of the hand. How much can I afford, or can I afford this space with the number of students that I'm able to license for this space? Okay. So another extremely important step in this process, if you're looking at a center that is outside of where you may have your current center, is to tour the childcare facilities that are closest to the space where you're thinking about opening. Online research can provide lots of helpful information, but it's not a substitute for the immense amount of insight to be gained from touring the competition. Um, are their programs full or are they only half full? If they are only half full, why? What can you learn about the quality of the program? If there are only traditional childcare centers in your area, you may be able to position yourself as a Montessori or an immersion-based school. If there's a good population of stay-at-home parents there, you may be able to open like a partial day co-op that would focus more on like parent volunteerism or child socialization and would require less staff. Okay. Yes, let me, got a question here. I'm going to go ahead and reshare that link. Oh, the Census Bureau. There we go. I think there's a link to the Census Bureau in the worksheet that I gave you, but let me double check. Let's see here. So there's that. Okay, perfect. Okay, so if we're then, the other thing that we have to consider when we're opening another center is the availability of employees. It is extremely important to do your research in this area well. This kind of research includes seeing how many job postings there are currently on Indeed for teachers. A lot of job postings can be a bad sign for your hiring efforts. It also includes looking at the average wage in the area. So while affluent areas can be a great place to have a center, it will also likely mean that you'll need to pay more. Obviously, we have an employee shortage nationwide at the present moment, and I have several clients that are sitting on top of a large pile of money because of grants, wanting to buy a center, but not feeling confident that they could staff it because they're having a hard time just staffing the center they have now. So I think that's a very legitimate concern. Okay, so what we're going to do next is we're going to look through a quick case study called Scaling Up Your School in Every Way with Nina Lemon. And she is the founder and owner of Lemon Tree Academy. So to start off, let me tell you a little bit about Nina. Throughout her life, she grew up around children. She was an aunt by the time that she was 9, so looking after children was part of her norm. She originally was a pediatric nurse, and then she became a teacher at an elementary school. And then when she had a child of her own, she decided to open up her own center. She started out with only one school. It had the capacity for 50 children, but she started out with just 5, 4 that were paying, and her daughter, and she scaled up to 50, and then she increased the capacity to 94 and filled those spaces up quite quickly. At the time, her biggest challenge was moving from working in the business to working on the business. She was a teacher, and she was also very involved in admin, accounts, all the general day-to-day stuff. So how did she move away from the day-to-day? Nina formalized the processes and systems that she used in her day-to-day world. She trained her staff to enable them to implement these processes and systems. She duplicated her in the business self in this way. She set an example for the rest of the staff. She gave them checklists and other tools such as job aids in order to support them. And the staff learned how to answer the phones, do the day-to-day activities, complete admin tasks, just generally the general operations. And she made sure that she had a team who could support her in her time of expansion. And I think that's an extremely important thing, that sometimes the team comes after the expansion, when in fact the expansion should come after you have your core team. During this time, she found that her most useful tool was video training. She used videos explaining everything that staff members needed to know, and this system allowed her staff easy access to information and allowed Nina to avoid the repetition and constant training. So how did Nina expand to her first school? Or expand her first school is what I meant to say, sorry. Nina grew her capacity from 50 children to 94 children by building portable classrooms on the property. She then relied on a lot of word of mouth marketing, implementing a reward system, families who recommended her services, and the families that joined because giving the recommendations received giving awards and rewards for people who did recommend her services, including gift card vouchers or discounted childcare. Nina then started to share photos and videos of school events and activities on social media. She basically bragged about all the good stuff that her center was doing, and that brought in the rest of the children. So Nina found a specific area nearby that she really liked, about 15 minutes away from her first school. She then wrote some offer to purchase letters to each of the schools in the area until one owner agreed to sell to her. This school that she purchased had capacity for 130 students, and the school was enrolled at about 60% of the capacity when she bought it. So how did she handle the staff shortages in the area? Nina found a lot of talented, passionate individuals who worked in other industries. So when hiring, she focused more on attitude and less on experience, knowing that she could train and invest in education for someone who was willing to learn. Okay. What growing pains did Nina experience while opening her second school? Taking over a different brand, I should say, is a very difficult undertaking. Before rebranding, she needed to win over the current parents of the school. The school had been running for 31 years, so this made change, even if it was positive, extremely difficult. And then she also found that the staff were quite top heavy in the admin department. Since she already had developed a really core admin team at her first center, she repurposed those that performed the weakest in their admin roles to being floaters and teachers' assistants. Okay. And there were three important things, but difficult mindset changes that needed to be made during this time. So one was seeing the importance of business management skills. Two was moving outside of the classroom into a management position. And three was working on the school rather than in it. It took time, but Nina soon realized that this was the best way to add value to her schools, their staff, their children, and their communities. I will share the links here in just a minute. While I'm doing that though, I would like to ask, for those of you, who are looking at expanding to a new center, what other challenges that we haven't talked about would you anticipate that you would see as you open up a new center or expand your current center? Yes, getting approved by the bank. And we will definitely be talking about that soon, Sonia. Like that is probably about 3 or 4 slides away. Is there any other challenges that you see that you would expect that we haven't talked about so far when you are looking to expand? Yes, so I also got one said, challenges could include building times and cost if you decide to build a new center. And yes, I think we all kind of have learned the lesson. I feel like the lesson used to be take whatever time and a cost that they tell you it's going to take to build a building and, you know, add 50% onto both. And now it feels closer to add 100% onto both of those things. Hopefully we're starting to get into a place where things are working a little bit better than they have been over the last couple of years, but I have not seen actual proof of that happening just yet. Okay. So what are the most important things that Nina did to ensure success as she expanded? Number one was delegation. Delegation is absolutely the most important thing you can do in running your business. If you can't delegate, you will burn out. End of story. And system and process implementation. That's the other really big thing you need to be able to do. If you want more information on how to implement systems and processes, I recommend checking out the book Clockwork by Mike Michalowicz. Not only does this book have a lot of best practices on creating systems in your business, but also it has worksheets and templates included. So again, that is Clockwork by Mike Michalowicz. Very good book. Really, most of his books are very good and highly recommend them. So these are the factors that have doing these things, creating delegation and creating systems and best practices and all of that. These are the factors that have allowed her to move to create a successful business that doesn't require her to work 80 hours a week in order for her to be able to do this expansion successfully. Okay. So let's look at the other things that the 3 actions that she implemented that produced positive results. So one is social media marketing. So sharing the center events and accomplishments on Facebook. You know, definitely don't be afraid to brag, but also remember to get the parents' permission before you share images and videos of children on social media. Next is recognition and rewards. Reward your staff for their hard work and their dedication. Rewards can come in many shapes and forms, and definitely get creative. You are more likely to retain employees that feel supported, appreciated, and celebrated. And again, get creative. Those rewards don't just have to come in the form of bonuses or high pay. They can come in little things like a dedicated day where you bring food into the center for lunch. They can be having an activity twice a year. They can be even just having, you know, like a once a month, you know, employee of the month sort of recognition ceremony. There are a lot of things that can be done that aren't necessarily tied to somebody's pay. And then she also created training videos and documents for staff so that they have easy access to policies, procedures, and other material whenever they needed it. And it also saves her from having to repeat training, and rather she can spend that time coaching and mentoring her employees. Okay, so next is looking at whether or not you should lease a building or you should buy a building. So let's say you found an area that you really want to open up a new center. The next decision is to lease or to buy. And I want to go over the pros and cons of both of these options. So let's start with leasing a building. So one, you'll have more access to liquidity because you don't have to make a large down payment on the building. Usually just your first and last month's rent as a deposit. Also, you will know what your monthly fixed costs are. Generally, major repairs should be covered by the landlord and you should not be paying property taxes, but I have also seen cases where this may not be the case. So I'd highly recommend having a lawyer take a look at any commercial lease before you sign it, because commercial leases are much harder to get out of or to renegotiate than residential leases are. Next, there is the common misconception that when you own a building versus leasing it, you get more deductions. And that's actually not really true. You actually get more tax breaks for every dollar you spend for property expenses when you lease, because the rent is 100% deductible, as opposed to a mortgage in which the principal payment is not deductible, only the interest, insurance, and property taxes are deductible. Also, a lease provides more flexibility if you want to reconsider or don't want to stay in an area long term. And plus, you'll have a faster turnaround time getting into a leased space because you're not dealing with trying to obtain the mortgage and going through that loan process. All right, so let's look at some of the cons, though, of leasing a building. So you can't build equity or benefit from the appreciation of the value of the building because you don't own it. You won't be able to collect passive income, such as renting out additional space in the building, unless you were lucky enough to have some sort of subleasing contract, but that's very rare. And you would be responsible for high rent payments, and you often have little to no control over the space. So let's look at then owning a building. So some of the pros of owning the building is that your equity in the property builds over time. The asset value also appreciates over time. You have the potential to earn rental income if you own the property, and you do get those tax breaks for interest, depreciation, and non-mortgage expenses. And plus, you maintain control over the property, which is a huge win for sure. All right, so let's look at the cons of owning the building. So obviously, you're responsible for a huge upfront down payment, which is a very large expense, as I'm sure you can imagine. You run into the difficulty of qualifying for financing. You may also be responsible for prepayment penalties on loans. And then there's also the potential for the loss of liquidity or capital, depending on what may happen in the area that you are located in. So these are just some things to think about as you weigh your options and decide if leasing or buying your next center is the right choice for you. Okay, what is the best way to create a training video? Great question, Barb. I personally use a system called Screencast-O-Matic. It's relatively inexpensive, and it can create both online videos, like videos that are stored online and have a link that you can just send to people, but it also can create a like a MP4 file as well, so that you can, if there's sensitive information or information you don't want in the internet, you can put it in a safe place where only certain people would have access to it. So I use it because I do a lot of videos for like reviewing tax returns, and obviously people don't want tax return information out there on the internet. And so it's my it gives me a little bit more security. Okay, so next we're going to talk about inflation. So as I have mentioned before, a lot of owners are hesitant to expand right now because of the hiring shortage. After all, if they can't hire for their current center, then they're going to likely have trouble hiring for the new center. And while I 100% agree with this rationalization, I honestly don't recommend sitting on a lot of cash right now. And that is because of inflation. So fun fact, about 1/3 of the cash that's currently circulating in the US today was printed in the last 3 years. Um, we're dealing with rising costs on everything that we spend money on, and this is all due to inflation. A 2-bedroom apartment or a used car, is not necessarily worth more than it was 2 years ago, but the value of the dollar is less, and so therefore we are paying more for those things than we had in the past. The US is a lot more insulated against hyperinflation than other countries due to the fact that the US dollar is the world's reserve currency. However, we are seeing the highest inflationary rates of the US dollar in over 40 years. And I don't believe that our economy is heading towards any sort of catastrophic collapse, but I do think that it is wise to invest excess cash in something that isn't as likely to lose value. So one thing to note is I did say excess cash. So having enough money in the business bank account to cover 3 months worth of normal expenses, including payroll and rent, is crucial. What we're talking about here is the amount over what you should have in your bank account to cover those expenses. That's what we would really call excess cash. So for example, I have a client in Texas who has 2 centers and she wants a 3rd center, but not right now because she can't staff the center that she has. She's also receiving somewhere around $1 million in grants from the state of Texas. So we've talked extensively about her options, whether to hold the excess funds in a bank account, whether to pay off her current center mortgage and other debts for her centers, or to buy land in an area where she wants to have her next center. And of all the choices, I do believe buying the land is the best option. And here's why. In purchasing the land, she is sinking her funds into something that is not as likely to lose value and will increase her income when she is ready to build her 3rd center. The second best option of the 3 that we talked about would be to pay off the mortgage or other debt. Right now, the inflation rate is about 8%. Her current mortgage rate is 5.5%. And with this information, it looks at, if you're just looking at it on its own and not considering any other information in there, this would actually mean that she shouldn't pay off her mortgage. In a high inflationary environment, the value of the mortgaged property goes up, the amount of debt stays flat, but the real value of the debt actually goes down because of inflation and because everything else is going up around it. And as a result, the equity in the property increases. So owning real property such as a building coupled with low interest rate mortgages tends to be a good way to hedge against inflation. The amount of the mortgage debt stays the same while the cost of everything else in the economy goes up, is essentially what I'm saying. So if the inflation rates exceed the borrowing rates, so in this example, inflation is 8% and your interest rate is 5.5%, the lender is effectively paying you 2.5% to borrow the money. So from an economic standpoint, it's not a great idea to pay down debt if the interest rate is less than the inflation rate is right now. But from an expansion point of view, You are much more attractive to a lender if you have little to no debt. When a lender evaluates you for a loan, they will be looking at how much of your cash flow goes into servicing debt. The more debt that you have, the more debt payments you have in comparison to your operating profit, the less likely you are to be approved for a loan. And we're going to come back to that in just a second. And the least prudent choice of all of these would be to let the cash sit in the bank, earning little income and losing value. So if you determine, though, that you would feel better just mentally to keep a bigger stockpile of cash, at least ensure that it is going into a high yield savings or a money market account. And you can also talk to your financial advisor about appropriate ways to invest the funds into a brokerage account. That is definitely not my forte, but with the stock market being as low as it is right now, it's not a terrible time to buy. But again, talk to your financial advisor before you make any of those kinds of choices. Okay, so going back to lending. So in general, you want to get to the point where your business is considered creditworthy on its own. And this means your business can take out a line of credit on its own or take out credit cards on its own. Usually this takes about 3 years for the business to get to the point of being considered creditworthy. Essentially, you need to have, a business credit card, a business line of credit, something like that for about 3 years before you've kind of proved that the business is going to be creditworthy. If you go to take out a large loan before the business has a solid credit score, the lender is likely going to ask you to be a guarantor on the loan. The good news about guarantorship is that it will not show up on your personal credit report. So if you're also looking at purchasing a house, this being a guarantor on that loan will not, when they pull your credit, count against you immediately. But when you disclose that you're a guarantor, that could be a different situation, but it depends on the lender. So with lending, there are a few things that can cause you problems. So the first one, as you can imagine, is a poor credit score. Lenders are going to be hesitant to grant you a loan if you have a poor credit score. So what can you do to boost your credit score? First, pay off your credit card balances in full before the monthly closing date. And I did say before the monthly closing date because you want the creditor to report a $0 balance to the credit bureaus in order to have the best possible credit score. You don't want them, even if you pay off your $10,000 balance after, once the bill is due, the credit card is still reporting $10,000 balance to the credit bureau, and that's what's showing up and can drag your score down. So you want to pay the balance before. Second is to consider credit history. A longer credit history will result in a higher credit score. So avoid closing out credit cards except when absolutely necessary, because shutting off the credit cards or closing out a line of credit can drastically reduce your available line of credit and negatively impact your credit score. Third is to think about hard inquiries on your credit. So when you go to make a big purchase like a house or a car, lenders will pull your credit, which will negatively impact your score. Keep this in mind if you're planning to seek out a loan for the business as well. Several hard credit inquiries in a short amount of time can cause the lender to think that you're having cash flow issues and make you a less desirable loan candidate. Okay, and what are lenders looking for on a business loan? So first, they want to see 3 years of profitable operations at a minimum. And this is becoming an issue for a lot of center owners because of the grant money and the PPP funds that were received. So lenders are identifying grants and PPP funds as one-time non-recurring activities, meaning that they're removing this income from the financials when they evaluate your profitability. The issue with this is that both the PPP and the grant funds come with requirements for spending, but very few center owners or lenders are identifying the spending that is happening that is only due to having these additional funds. So this is causing the financials to look very negative because there are more expenses that than normal, and that's all due to the spending requirements of the grant money and the PPP. So if you're considering a business loan in the next couple of years, I would highly recommend keeping a listing of expenses that have occurred directly due to the grant funding. If there's curriculum you purchased, professionals or coaches that you hired, raises that you gave, bonuses that you gave that you would not have otherwise given if it wasn't for the money that you received from the state or from the PPP, if you would have had to have laid people off at the beginning, if it hadn't been for the PPP, keep an accounting of all of that so that the lender will understand the unique circumstances that you're in, and it'll shine a more positive light on the financials, because then we can also take out those one-time costs. So we're not just taking out the grant revenue, but we're also taking out essentially the grant expenses so that the financials look a little bit more normal to the lender. And then the second thing that a lender is going to want to see is minimal debt and positive equity. So in your financial statements, there is a report called a balance sheet. And the balance sheet shows your assets, such as bank accounts, fixed assets, and deposits. And the balance sheet also shows your liabilities, such as credit card debts, loans, and accounts payable. Your assets minus your liabilities total your equity in the business. So if you have more assets than liabilities, meaning you have more cash and accounts receivable and fixed assets than you do debt, then your equity is positive. If you have more liabilities and assets, or liabilities than assets, so more debt than you have cash, accounts receivable, fixed assets, all of that, then your equity is negative in that situation. And lenders generally won't loan to a business if the equity is negative. And the less debt you have, the more attractive you are to a lender. So that's definitely one thing, I mentioned up front, things that I help work on, and it's getting financials lender ready. And there are just some things that can happen in the financials where, there's not a meaning to create something that looks really funky to a lender, but sometimes it just happens. So sometimes what somebody might create a debt, like a loan to the shareholder or something like that, that's never really ever going to get repaid. They just did it because the shareholder did this, and that, but there was not a real serious possibility that they were going to be getting paid back like you would think. Well, that debt still makes the financials look unattractive to a lender. And so before you send your financials to a lender, I would highly recommend letting your accountant know, this is what I'm planning to do, and make sure that they're looking at the financials from a lending perspective so that it looks as attractive as it can while still being accurate. Okay. And third, the lender is going to want to see solid current year financials. And then they're also going to want to see a 24, or at least a 24-month forecast, sometimes up to 5 years. That would include the new debt payments that you would be taking on with this loan. So essentially, you need to show a business plan to show how you're going to make money with this loan. And so, that's what they're looking for on a business loan. On a personal loan, they're basically wanting to see the same thing as a business loan, but the only caveat I would make is on a personal loan, lenders tend to put more credence into the owner's W-2. I don't know why. You can show the same amount of income split between W-2 and business income, or just business income, and the lender will always take the W-2 plus business income over like the straight business income. They really focus in on what you're paying yourself via W-2. And I think it just has to do with the perception that it's an established business that has the money to pay you, so you're getting paid like any other employee. And whether that's accurate or not is besides the point, but lenders just love W-2s. So let's go over some best practices when it comes to lending, though. First is talk to the lender about everything. Ask about a minimum credit score that is required for the loan. Ask about anticipated loan rates, down payment requirements, expected terms, estimated time to close, and only apply when you're confident that you will qualify based on what the lender is telling you. And then next is obviously review your credit report whenever you apply for a loan. If you are going to have to be a guarantor on it, you are going to want to make sure that you have a minimum credit score of between 720 and 750. That's kind of the ideal credit score for large amount lending, large dollar value lending. Okay. So we, like I said at the beginning, we've created a document for you that, again, the links should be in the chat. Let me know if somebody still doesn't see them, if they came in after I posted them. I think apparently the chat only shows up at the point at which you came in. I'm happy to repost those. But we've created a useful checklist that you can go through when you're planning to expand. And we'll find that checklist on page 9 and 10 of the workbook. And then just read through all of that on your own time. And remember that the workbook is interactive, so you can check and uncheck boxes. Just make sure that you save the changes to the workbook. Okay. And I think that just about wraps up our webinar. I know I've got one more message in the chat, and of course, I'm happy to answer any questions that you guys have about what I've talked about. But I do want to thank you guys for joining me today. Just a final word, a great way to get some extra funding for expansion is to apply for the employee retention credit. If you have not yet applied for this credit, please contact us at erc@honestbuck.com to get more information about this credit and how we're helping childcare centers apply for this. And then, of course, I will also be sending out an email inviting you to our succession planning webinar in December. And feel free to ask any questions that you have. Let's see, we've got one question. Oh, yes. Marcia, Screencast-O-Matic is awesome. Anybody else have any other questions? I'm happy to stay on for another 3 to 4 minutes while I wait for questions. But if you don't have any, then I really appreciate your time, and I hope you guys have a great rest of your day. Thank you guys. Thank you, Marcia. Absolutely.